Good evening, everybody. I know everybody had a pretty crazy couple of weeks here, so I decided to put just a sort of a quick high-level video in front of the paywall for this week. In last week's video, we talked about the fact that we were coming in and it really looked like we wanted this 3-year back test. You can see 21, 22, 23, like almost a perfect box. You can have the bottom, in a different spot, that's fine, but it still was a 3-year box that we broke out in 2024. We came back and we back tested that nearly perfectly, not quite to the highs of 2022 that we were looking for, but we did touch the highs of 2023 and sort of just wicked into it by a little bit. We were looking for this partial back test of the 2022 highs at 48.30s to 48.70s. We hit 48.32 on Sunday night off our 48.32 to 37 half level. Again, I think everybody's eyes were on this, and it's such a powerful technical setup that I said last week that, almost certain to hold, and obviously it did. One thing I'll note is that this is a non-back adjusted chart. If you are using a back adjusted chart, it'll look completely different, and I'll use this as an opportunity to demonstrate just one example of why I use a non-back adjusted chart instead of a back adjusted. There's back adjusted, so looks quite a bit different, right? Nowhere near any kind of a 3-year back test at all. It's got us taking out 2024 lows. Very different situation than this, right? Moving over to SPX real quick, you can see SPX looks a lot more similar to the ES non-back adjusted chart with a nice partial back test of the 3-year breakout. I also suspect there are a lot of eyes on some kind of a trend line here. It's not really my style of trading. It didn't really matter a whole lot to me, but it's just another reason to expect this area to find some buying activity, at the very least, some covers. So heading into the week, I've gone ahead and I've boxed out this range starting from the Thursday high. And I'm going to go ahead and put the bottom, at least for now, at Monday's open. And maybe you'll see why in a minute. But you do have two kind of candle bodies here and just a couple of wicks below. That may look kind of obvious. The top, obviously, a clear spot here underneath this volume that could potentially be problematic. So to me, to feel comfortable that we have broken this range, I'm going to need to see this range break with continuation. We've got a couple of gap fills. We've got a gap fill here, actually, and then this is weekly structure up here. Our potential, lower weekly highs can come in below here. And I'm going to kind of look left, and you'll see kind of how clean this lines up with previously traded prices. This here, this 51.15, that was Thursday's low, and I believe that will be important. But let's look left over here. So first of all, look where the bottom of the box is sitting. Right at a very key previous sort of support and resistance, if you will, or a prior range that we had traded. We have Thursday's low pretty much right at the August low. So that's something to note of interest. I've got the Thursday close marked out because certainly coming into Wednesday, that could have been a potentially tricky spot, maybe a gap fill reversal. Now, obviously, we have the news and we just sort of ripped through there, but I feel like it could still be potentially problematic next week or relevant. And if you look left, you can see it's basically sitting right here off of this September pullback and this July pullback. So clearly a key technical spot as well. So let's just make that a solid line while we're at it. So to me, if we get some kind of gap down or any kind of further consolidation in this range, it's not necessarily bearish or bullish. Given the preceding trend into it, I think it would be fair to call that bearish consolidation for new lows. It's a sort of a general principle, but again, the importance of this massive 3-year breakout backtest is definitely enough to give us reason to sort of maybe lean with bulls here. I think any kind of continuation below Thursday's low is potentially problematic. I would expect at least a back test of sort of the bottom of this box. And, wicks are fine. We could just come down here, sweep Thursday's low, and rotate back up. But any kind of continuation below Thursday's low, I think we're coming back down here. And you could probably expect to retest Thursday's low if we got some kind of gap down that took out, Friday's low. No reason to think it's going to happen at this point, but that's generally what I would expect. And I wouldn't immediately get bearish, again, just because building out, honestly, the more volume we put in, especially down towards the lows, and the more time, I think the better, because this was an after hours low, which is, suboptimal perhaps, but I think we can forgive that because of the importance of that 3-year back test. But, additional volume down here that doesn't break to the downside could just be additional accumulation. And that wouldn't necessarily be a bad thing to see in terms of the durability of an eventual upside breakout. So areas of concern, I would certainly have, the April 2nd open and potentially the low. We've got, gap in here that should act as resistance at first touch. So, I mean, if we come up here and we sort of sweep Thursday's high, Thursday the 3rd, anyways, fail back in range, that could potentially be a bearish setup. Now, I will say we've seen this a couple of times where bearish setups have not necessarily yielded bearish results. We effectively had started watching this 3-day range here, which we broke to the upside on Wednesday. Thursday gets that huge gap down, trades all the way down into this range, which opens the potential for coming all the way back down to the bottom of this range. And instead it was bid and it was relatively firm, and it did not make it all the way down. So sellers weren't particularly interested in taking this down to the lows, or we had some strong buyers step in. Again, I would prefer a little lower, but that's okay. We still saw buying come in, and then we got a follow-through day on Friday. But generally, if we go ahead and we attempt this upside break, early in the week, and we sustain that break, and we don't get some kind of failure off this gap to kick us back down below, if we're sticky up here, I mean, I don't see any reason why we can't come up and test, this lower high up here. We do have potential for a gap fill reversal. There's a lot of ES spots that we'll cover in the full weekly plan that could potentially be a little bit trappy. But I think that generally applies that if we're sort of sticky in this range, we could be looking at, a gap fill here and ultimately maybe up to this this high here. If you look at your weekly chart, I've got the 5 SMA on the weekly chart. And you can see that's where we failed at the high of the week. You can also see, again, how key this spot has been. And so sustaining above, this past week's high, we're sort of monitoring just a little bit higher to include that Thursday range. But, it definitely makes sense to potentially come up here and retest the preceding week's high, taking out last week's high would at least bring the weekly to balance. That could end up being a 4 or a 5-week balance. We don't know. That could build out further. But it does, put bulls in a decent position to try to come out and take out this lower high. You can also see the relevance of this lower high, right? So this was basically a key back test of the breakdown from this range. So critically important to ultimately take out and sustain this. And then all of this is on the table, honestly. So whatever you think, bear or bull, we have to be aware of the possibility that above here brings all of this into play. So, if we get some news, we get some radical change in policy, you just never know. We've seen how these markets work. So we'll keep an open mind. I had previously mentioned the cross of the 21 EMA down below the 200 SMA. So 200 SMA in yellow, the 21 EMA in red, and I still get the 5 SMA now on daily in blue. So you can see we held the 5 SMA at today's low. So that's a pretty good look, and certainly would suggest that a retest of the 21, which has been, active for the most part, would be reasonable. And from there, again, if we can sustain here, then you get tests of your 200 and this structure here. Now, if we fail those tests, we're still going to need to ultimately get back below this range here for bearish things to happen. So it's not a situation where, like, if we break this range and sustain and we're holding it from above, I'm not super eager to lean in and try to front run any shorts. But doesn't mean I may not take a shot at the day trade or add some hedges to longs, but I'm going to be pretty cautious if we are sticky above this sort of box range here, because again, I expect us to come up here, test the 200 and test this structure as long as we are holding above this range. Flipping back to the weekly real quick, we've got the 21 EMA on the weekly that's declining now, which hasn't happened in quite some time. So that could make its way down into this range and potentially be reactive. And one last thing on the daily, specifically with respect to the 21 EMA and the 200 SMA, what we saw in 2022 a number of times is that we would reclaim the 21 EMA, come up and test the 200, and there were even a few times that we crossed the 200, but the 21 EMA itself never crossed the 200. And so after the bearish cross, we never had the 21 EMA cross up the 200 SMA until, that was pretty much like the bottom was in at that point. So I'll go back and look at that. So here we are. Here was the 21 crossing down the 200. Okay, and you can see we rallied back, we reclaimed the 21, it began rising. We even did reclaim the 200. We did sweep this structure here. So a lot of people thought it was over, and that was it. 21 EMA did not cross the 200, consolidated here, and then gapped down and back tested the 200 from below, and it was sort of lights out. You can see that after that, the 21 never really came close to the 200 until that 200 declined substantially. You see the 200 was reactive here again. Like even though we reclaimed the 21 on some of these rallies, we were still failing the 200 from below. Here, we crossed the 200. We crossed the 200, but the 21 EMA did not. So these were not sustained reclaims of the 200. Now, the bottom was in at this point in time, but we still really didn't get going until the 21 crossed the 200. And you can see we got this last pullback, but the 21 never crossed back down the 200. And after that, it was just, I mean, ugly, but it still was a higher low in March relative to this key structural swing low. So that's definitely something that I am watching, is whether or not the 21 EMA will cross back the 200 SMA. You can see in the sell-off in 2023 in October, never crossed down. So, I mean, this looked disgusting. We traded below the 200, but again, the 21 did not cross the 200. So those are kinds of the things that I'm looking for to keep me a little bit cautious and keep me centered. So to summarize, basically, if we continue to fill out in this range, I'm not necessarily bullish or bearish, just somewhat neutral. Have been adding to long accounts, but I'll maintain neutrality on sort of a short-term time frame anyways. Below Thursday's low, probably retesting the bottom of this range. And then, if we come up here and we fail, the top, look above last week's high and maybe this high, and then get sucked back in, then it looks potentially problematic, especially once we're back, below Friday's high, I would think. But sustain an upside break, reclaim the 21 EMA, and I see no reason why we're not coming up here for this gap fill, a test of the 200, and a test of this structure up here. So that's about it. Have a good weekend, guys.